Welcome to Citigold series on all things investing. On this episode of Demystifying Wealth, we are covering hybrid funds. Hybrid funds are exactly what they sound like. They are mutual funds that invest in multiple asset classes at the same time, with the minimum being two. These can be assets such as equities, debt, cash, gold, and more. Today, we'll take a look at 5 types of hybrid funds. These are determined by the asset classes the hybrid funds predominantly invest in and the style of managing them. Let's start with conservative hybrid funds. These are funds that invest 75 to 90% of their portfolio in debt instruments, otherwise known as bonds, and the remaining in equity instruments, which are shares of companies. As we know, debt instruments like bonds can provide a fairly low risk and steady stream of income in the form of coupon payments to the investors. Therefore, this type of funds usually suits investors who have low risk tolerance. The aggressive hybrid fund, on the other hand, can invest 65 to 80% of the corpus in equity instruments and the remaining in debt. With an investment style almost completely flipped from the conservative hybrid funds, this type of fund may suit an investor that believes high risk reaps high rewards. Another category called Dynamic Asset Allocation Fund or Balanced Advantage Fund invests in equity and debt and is managed dynamically. These generally follow an asset allocation model that allocates between equity and debt based on the market conditions. As conditions change, the percentage of corpus invested in each asset classes changes too. This differs from a next type of fund, the Multi-Asset Allocation Fund, which is required to invest in at least 3 asset classes with a minimum allocation of 10% in each asset class. For example, investors may find a multi-asset allocation fund that invests in equity, debt, and a commodity, such as gold. Finally, we will look at arbitrage funds, which have potential to generate returns by adopting an arbitrage strategy. This simultaneously buys and sells securities in different markets to take advantage of price differentials across markets. It is low risk if these opportunities are taken advantage of quickly. Overall, hybrid funds aim to achieve diversification and capital appreciation in the long run through a balanced portfolio. Now that you know a little about the different kind of hybrid funds, you can make a more informed decision about what kind you would like to invest in, keeping in mind your risk preferences and investment objective. We at Citi simplify investing so you can get started early. Take the first step. Talk to your relationship manager today.